The days are getting colder here in the desert, and now daylight hits the mountains long after those of us on East Coast time have actually started work. But before we get to December 31, I'm going to tell you now 9 things that you could do immediately to potentially lower this year's tax bill. But make sure that you run each of them past your own CPA first to check that it's right for you. Idea number 1, if you've been thinking about rooftop solar, new HVAC or new windows, new insulation, installing them by year end might qualify for the energy efficient or clean energy tax credits before they're dismantled by the Trump administration. They've been running at about $900 or $8,000 a piece. And remember that tax credits are far more generous than itemized tax deductions. They're a full-on dollar for dollar cut in your tax bill. Idea number 2, estimate your income for this year and your tax rate, and then what tax bracket you'll be in for next year and that tax rate. If the 2 years are different, if the tax rates are different in each one, then consider shifting tax deductions or tax liabilities between them. For example, you might shift when you execute a Roth conversion and its tax liability. Remember, Roth conversions always have a December 31 deadline. Or you could shift charitable donations for their tax deductions, or if you can, you could shift large medical bills between the 2 years. Idea number 3. If you're in a high tax bracket, receiving big bonuses, or if you're self-employed, you might consider trying to defer your income to future years if you expect that your tax rate will be lower. Idea number 4. For late taxpayers, the IRS will be charging a 7 or 8% penalty this year due to higher interest rates. That's probably more than you're earning on your cash. So you might want to make sure that you've absolutely prepaid your income tax where necessary, especially if you had a windfall during the year. Now, as you know, that's 90% of your likely tax bill for this year, or 100% of last year's tax bill, 110% for high earners. Idea number 5, if you've got losses on stocks or other assets, you might want to sell them now to realize those capital gain losses. The CPA could then carry those losses forward to cancel out any capital gains tax bills that arise for you in the future. Idea number 6, conversely, if your tax bill's looking unusually low for this year, you might sell appreciated assets to realize their capital gains now when your tax rate is low. Idea number 7, maximizing your retirement accounts, your retirement contributions, is often clearly one of the easiest ways to reduce your taxable income for the year. So don't forget that most 401ks have a December 31 deadline. Although in fairness, IRAs and Roth IRAs, well, you can wait until April's tax filing deadline to fund those later on. Idea number 8, contributions to health savings accounts are tax deductible for federal taxes, but they too have a calendar year deadline. And idea number 9, don't forget to spend those use it or lose it funds in a flexible spending account by December 31. Or check if your employer offers either an FSA grace period or the ability to roll FSA cash into next year. One more tip. If you're in certain parts of California, you might get an IRS extension because of January's flooding. But again, as ever, you're going to have to check that with your CPA. At California Financial Partners, our list of suggestions to potentially cut your business or personal tax bill runs to over 100 pages. CFP, here to help.